For WTI, although the Federal Reserve is expected to keep interest rates unchanged, the recent volatility in oil prices has complicated this outlook. Earlier inflation data suggested price pressures were easing, but the jump in oil prices raised concerns that transportations and consumer costs could rise again. With oil now pulling back, those risks have eased somewhat. However, the policymakers will be watching closely to see whether the decline is temporary or a start of a more sustained trend. For investors, the focus will be on the Fed's comments about the inflation and energy prices. Even if rates remain unchanged, the central bank's guidance could shape expectations for future policy and drive market sentiment in the weeks ahead. For the USD, the Fed's interest rate decision this Wednesday is the most important risk event this week. Overnight index swaps suggest a roughly 1 in 3 probability of a rate hike. There will be no summary of economic projections or dot plot this week, only a policy statement and Warsh's press conference. A statement as brief as June's, the committee will achieve price stability, would only increase confusion. Warsh has repeatedly stated that he will not provide forward guidance, preferring market assessment of data rather than relying on central bank signals. If the Fed holds rates steady, given the market has already priced a fairly high probability of a rate hike, the dollar may face a sell-off. Subsequent market reactions will depend on the tone of the statement and how Warsh handles questions. And for precious metals, the uncertainty surrounding U.S. monetary policy will largely depend on inflation data. The market is currently pricing in a 34% probability of a July rate hike, but it is more inclined to bet on a September action. New tariffs of 10% to 12.5% on imports from major trading partners have added another layer of uncertainty, potentially triggering a second round of inflationary effects and leaving the Federal Reserve with even less room for maneuver. Geopolitical events, the Fed's decision, and the PCE price index in the coming week will influence gold prices at the close of July. Strong data could intensify bets on the September rate hike and make $4,000 a downside target again. Any signs of easing price pressures could provide potential support for gold. However, given that oil prices are hovering around $100, the window for sustained easing is narrow. Ultimately, $4,000 remains a structural bottom to watch. A clear break below this level would open up room for a move towards $3,950 and $3,900. If this level holds, gold prices could rebound to $4,100 and $4,200. While rising interest rate expectation may weigh on gold, some analysts believe that the ongoing conflict in the Middle East is creating a potential turning point for the precious metal.